We're going to get started, everybody. Welcome. Welcome to Ivy Capital's webinar. We're excited to have you all here. My name is Jeff Guberman. I am the CEO of Ivy Capital. For those that don't know us, we are a real estate private equity company specializing in student housing in the Southeast. We look for those properties that others have overlooked, that others don't realize have immense value, and we purchase them, renovate them, create that immense value, and sell them. And looking for north of 20% IRRs, and we usually sell within 3 to 5 years. But I'm very, very excited to have join me today Gian Pazzia with KBKG. He is a friend, he is a fellow YPO member, and he also performs all of our cost segregation studies. But so, in addition to being an active real estate investor, he's been helping real estate owners with cost segregation tax strategies for 27 years. He started his career at Big Four accounting firms, not as a CPA, but as a structural engineer. And he's become a recognized leader in the cost segregation field, serving as a former president of the American Society of Cost Segregation Professionals and sitting on their board of directors for a decade. Gian is one of the few experts that have provided expert witness testimony on cost segregation issues before the IRS. Wow, that's pretty cool. He's been published over 20 times in major journals, such as AICPA's Tax Advisor and B&A Bloomberg, and he's been invited to speak to thousands of CPAs and real estate investors. He's also co-founded KBKG, the national leader in cost segregation studies, with offices from coast to coast. So, welcome, Gian. I am so excited to have you join us today.
Thank you so much, Jeff. How's my sound right now? We good?
Perfect. Perfect.
All right.
Perfect.
Well, thank you for having me and really excited.
Well, tell me about your entrepreneurial journey, how you got started in this, and I know you've been in real estate since you were a kid, basically.
Yeah. Well, my father got into real estate when I was a kid, and that's kind of how it started. But yeah, my parents were immigrants from Italy. They were born there. They grew up as in their early teenagers, came over here. I actually grew up in Boston. That's where they immigrated to. And my mom was a hairdresser, and my father was a pizza man. So, right, typical Italian immigrants, right, that came over off the boat and just trying to make enough to survive. So, my parents, I think, worked super hard. I think like a lot of people in those days. And one of the things that I got from my dad that, he understood numbers, right? He was good with math. And um, he figured out that real estate was something to invest in. And so he was fairly successful and was able to retire earlier than most people at the time, and yeah, got into that real estate game and kind of started, implanting in me kind of that financial discipline, and always kind of thinking about the future. And so, um, you know, when I went to college, you mentioned I'm a structural engineer. I figured out my last year of college that I didn't want to be an engineer anymore. Didn't want to sit behind a computer all day, and ended up working for Arthur Anderson at the time. They needed engineers to come in and look at construction blueprints for big casinos and pharmaceutical manufacturers, and to identify all the different components in those buildings that could be treated differently for tax. And that was how I got into cost segregation. Yeah, my first job out of college, spent some time with Big Four accounting firms, ended up coming out to California, co-founding KBKG about 27 years ago. And yeah, along the way, as I watched my clients utilize cost segregation to, all the planning that goes involved, that's involved to kind of mitigate their tax. Yeah, I started doing it myself. So I'm an active real estate investor along with my wife, and yeah, happy to be here today.
That's amazing. It's so interesting to me that there's so many people in the real estate world that started somewhere unique and different. I also did not start in real estate and kind of had a circuitous journey here. And I think that makes you a much stronger investor to understand so much more outside of just real estate. Um, and so start at a remedial level. What is cost segregation and why does it matter?
Yeah, so cost segregation, it's a strategic tax planning tool that allows real estate owners to write off parts of their building much faster than the structure of the building, right? And so normally, a lot of your deals are multifamily. You're supposed to depreciate and write off that multifamily property over 27 and a half years. But there's a lot of stuff inside the buildings, like things like certain removable flooring, maybe cabinetry, even the piping and wiring to the appliances. We can establish a value for all of those things and write them off all in year one because of the Trump tax bill reenacted bonus depreciation. So there's huge value to taking all those deductions right away, right? And so it's like a time value of money play to do this. And as you know, very common in real estate these days.
Absolutely. And I'll just say, as an example of this, uh, Gian did a cost segregation study for one of our properties this past year. We closed on that property December 31st. There was about $6 million of equity in the building. And on our K1, we had a tax loss of over $5 million against $6 million worth of investment. And so for me personally, that helped my taxes dramatically this year. Um, what happens in year two, three, four, five? How does that work? So if I've taken so much in year one, what happens in those subsequent years?
Right. So, like I said, if without cost seg, you're taking the same amount every year, right? And really, the power of cost seg is taking these deductions that you would have gotten out in 27 years from now and taking them today. And so you're going to get slightly less depreciation than you would have if you didn't do the cost seg study, right? But you're still going to get some depreciation. And it's also going to be fact specific. So I know in your deals, you acquire the property and then you're spending sometimes significant dollars in subsequent years to renovate. And so, there's going to be expensing and depreciation related to those subsequent improvements in the second, third, fourth, and fifth year, et cetera.
Got it. So just making up numbers, if it's $1 million investment, maybe we're going to get an $800,000 loss in year one, even if we had distributions and we gave cash out. Year two, it might be 50,000, 30,000, something like that. So a much smaller number.
Yeah, a smaller number, exactly. And I don't know if those numbers but you get the point there. It's going to be call it, if it was $1 million of equity in your example, right, for your property, and there was about 60 or $70,000 or six or $700,000 of depreciation in year one. Years two, three, four, and five might be, yeah, like you said, 50 to $80,000.
Awesome. What happens? So what happens when I renovate now? What does that do? So I buy the property today. We do a cost segregation study today. 6 months from now, I put $10 million into the property. Now what?
Yeah, yeah. I think one of the primary benefit of cost seg is when you're buying the asset, everything has a value that you're purchasing, you're establishing the value, and you're accelerating everything from that acquisition price. There's a when you in a later year, years two, three, or four, renovate that property. And let's say you're renovating the windows. You're spending $1 million in years three renovating the windows. Well, on the original asset, the cost seg study put a value to the windows. And by the way, that didn't you didn't get to take bonus depreciation on the windows, right? That stays stuck in this 27-year life. But in year three, if you actually replace the windows, you actually get to go back to that cost seg study, figure out what the value of the windows were when you bought the property, those old windows, and you get to write that off. So that's another kind of secondary benefit of cost segregation that probably doesn't get talked about enough.
That's awesome. So I need to bring you back in after I do my renovation so that you can give it a second look and then we can start over with our schedule for what our depreciation looks like.
Yeah, exactly. If there's any major things being removed from the building, you really should look at that every year.
Got it. So now I sell the property. Now what happens?
So if you're selling through a 1031 exchange, you just roll over your basis into the new property, and everything just keeps going. If you were to sell for cash in a short period of time, there's something called depreciation recapture. Okay. And what that means is if you're going to take a write-off on an asset, let's say you write off $1 million in year one, and then you sell that asset in year two for $1 million. Well, the IRS says, wait a minute, you got to deduct this last year, and now you're selling it for the same price. Normally, when you sell an asset for more than you bought it for, you get a capital gains tax, right, of about 20%. What depreciation recapture is it's saying, well, since you have zero basis on that $1 million we just talked about, we're not, that from zero back to 1 million, you're going to get taxed at the ordinary rate, not the capital gain rate. And if you're selling for more than what you bought it for, that's the capital gain rate. So recapture basically means you're paying ordinary tax rates on any depreciation you took. And that happens when you sell for cash. And yeah, a lot of people talk about that. And look, if you're selling way into the future, uh, paying recapture at a later time, it's not so painful because one, you're getting the time value of money to hold, to take those tax savings and invest them in other places. And number two, there's other ways that you can mitigate um, the recapture tax. One, 1031 exchange, and there's other strategies as well.
Got it. And you mentioned this earlier, but just to fall back to this. So let's say I threw those windows in the dumpster. Do I have to still recapture the value of those windows? How does that work?
Yeah. That's one of the ways to mitigate recapture. So, um, in your example, you buy the property in year one. Uh, you, you, let's say the cabinetry and the wiring and all that stuff that you got to take bonus depreciation on, you wrote off right away in year one. And let's just stick with cabinetry for a second because it's a big dollar item in buildings. So let's say it was $1 million worth of one of your properties. Now in year three, you replace all the cabinetry for some reason. You throw that in the dumpster. Now in year five, you sell the property. Okay. Because the original cabinets that you got to take depreciation on are gone and you're not selling those in the transaction, you do not recapture the depreciation on that, right? And so it's important to keep track of, if stuff that you took depreciation on is no longer in the building when you sell it, that's one way to make sure you avoid recapture. And I can tell you, it gets missed a lot by CPAs, unfortunately, and it can be meaningful.
Got it. We're talking a lot about what's clearly residential or multifamily in cabinets and countertops, etc. What about other asset classes? How does this work across other asset classes?
Yeah, it's the same concept. It's when you're talking about an office building, you're just looking at different finishes, but the power that's powering all the computer equipment and the voice data cabling and a lot of the finishes in the break room, or maybe it's a data room with HVAC that's cooling the computer equipment. Um, every building kind of has different things inside them that we have to go through kind of a legal analysis to determine does it meet the criteria. But yeah, every single type of building can qualify for cost segregation. It's just a matter of like um, some buildings have more of the good stuff than others.
Got it. So if I really care about my depreciation, what are the asset classes I should veer towards, and what are the ones I should stay
Yeah,
away
yeah. Well, you and I were talking about this recently, and I mentioned gas stations and car washes, and not the sexiest from an investment standpoint, but from a depreciation standpoint, there's special rules that allow you to write off the entire building for a gas station and a car wash. So you got to subtract land first, right? Whatever's left over is building and improvements. For those two assets, write them off completely. And then, outside of those special rules, things like medical office buildings tend to be, have a lot of good stuff in them. Residential rental typically has, is on the higher end of depreciation benefits. Um, Restaurants, and then on the lower side, it's things like warehouses, industrial, um, properties that maybe are in an urban area that don't have a lot of parking and land improvements around them. That kind of gives you a flavor for
Got it. So
for the different types of
warehouses
buildings.
are worse because they don't have a lot of expensive things that depreciate quickly. They don't have, yeah, they don't have fancy countertops, and they don't,
Yeah,
it,
exactly.
it's just nothing with a short life. It's just a shell and land.
Yeah, I mean, there's some office space and there's some stuff here and there. It's just
Got it.
much lower and much less.
Got it. So talk to us about being a real estate professional and what that means and why that matters to your tax rate. So my depreciation, what do I do with it? How do I get taxed on that?
Yeah, look, you talked about real estate professional, and most people don't, don't fall into that category, right? They have day jobs where they're a software engineer or a lawyer, and they get taxed, you know, based off of W-2 income, or maybe they're an owner in a business and they get K-1s from the business. And, if you're a high income earner, you're taxed at ordinary 37% rate on the top end for Fed. And then, of course, there's always state taxes. And with real estate professionals, there's this special category that's existed for a while that gets very favorable tax treatment. And um, if you can qualify as a real estate professional, you can use I should step back, Jeff. If you're a software engineer or a attorney and you go out and buy real estate, right, you're considered a passive investor. And when you're a passive investor, you can generate all these losses from the real estate, but you don't get to use those losses against the income from your, we'll call it your active business.
What would I use it against? What if I am a passive investor, what do I do with that?
Yeah, so when you're creating losses, you can use them against other passive income. So if you have other real estate properties that maybe you've held in that you're not generating enough deductions, you can use that against that income. Yeah, so you're gonna essentially use it against any passive income.
So a passive
Um,
gain from the stock market. I sold my Tesla stock.
yeah, unfortunately, no, there's rules where stocks don't count. It's kind of stuck there and suspended if you can't use it against
Okay.
other real estate income. But if you can qualify as a real estate professional, it changes the game. It allows you to use the losses from real estate against all of your business income. Could be from your, if let's say you're a 1099 software engineer. But the key is you have to qualify. And so how do you qualify? Um, the IRS says you have to spend 750 hours a year uh, in the business of real estate, and 500 of those hours have to be essentially managing real estate that you own. Like you have to be kind of like actively in the operations of real estate. And And so, that's one of the criteria. And then the other criteria is that you can't spend more time in any other activity.
Hmm.
So what that means is if I'm a software engineer and I'm spending 1,000 hours in my software business and I only spend 751 in real estate, I don't qualify as a real estate professional. I'm going to need to spend, over 1,000 hours in real estate to meet that criteria. So anyway, that's the two criteria. But if you can get there, it just opens up a whole kind of world of what you can do from a tax planning standpoint.
So talk to me more about how I would get there and talk about the tools that you use.
Yeah. So I created this app. It's called Track 750, specifically for people that are, kind of in that spot where they want to make this election that they're a real estate professional. I'm going to share my screen here. You see that?
Yep, perfect.
Yeah. Anyway, so this phone app, I'm giving it away for free. Basically, carry it with you on the go when you're managing your properties. It actually coaches you on what kinds of time qualifies. So if you're spending time reviewing deal sheets, going to visit properties, talking to tenants, coordinating routine, repair and maintenance kind of things. There's categories in the app for all of that. And at the end of the year, it will segregate and show you, okay, this amount of hours qualifies, this doesn't. And it even coaches you along the way, like each month, telling you how many more hours you need. But the key is at the end of the year, you can hand this report to your CPA and they'll feel comfortable reporting you as a real estate professional on the tax return, which again opens up some tax planning opportunities.
Got it. So, in other words, I self-report as a real estate professional, and then if the IRS decides that they want to dig in deeper, I've got all the backup to prove what I've already self-reported.
Yeah, absolutely. Now, a guy like you, I don't think the IRS is going to question, right? Because
Yeah,
they're going to look at what you do with all your time. You don't have that, you know, significant other business income and activities. But where it
right.
gets, difficult is, a lot of people aren't full time in real estate like you are, right? They are part time, and then it starts to become a question of can I get there by spending this much time? And they have other business interests, and so this would be perfect for those types of investors.
Got it. All right, so let's shift gears for a second because I know you've got one other program that you offer for energy incentives. And so this was brand new to me. I had never even heard of this until you started talking about this. So why don't you explain that one?
Yeah, yeah. You mentioned you guys were doing a deal. Was it in Carolina, South Carolina?
Yeah, Charleston, South Carolina. We're building 134 units.
Right. Yeah. So when you're doing ground up development, there's a tax credit out there related to energy efficiency. It's code section 45L if you wanted to look it up. And what it is, it gives you a up to $5,000 tax credit if the building meets energy efficiency criteria. They changed the criteria, and really, there's I think it's what do you call it? Not lead, Energy Star. So if
Mm,
you meet the Energy Star criteria, um, you can get that $5,000 credit per unit. So on 100 unit building, that could be a $500,000 of credits. And there's other qualifiers in there, Jeff. If you recall us talking, if the building um, is if you're paying prevailing wages through the contractors, that's how you get the full 5,000 dollar credit per unit, and yeah, it could be lower if you don't meet that criteria.
got it, got it. Yeah, as we were talking about this, so we are not paying prevailing wage. We found that it was going to be about a 20% increase in our construction costs. But some, and that's in Charleston. other markets, you can pay prevailing wage and it's almost identical to market wage. And so it really depends on your market whether that makes a difference or not. We were working on a project in Cleveland, and prevailing wage and market wage were really almost the exact same number. So we could go union, and it was almost the same thing as
Yeah.
market rate.
Out of curiosity, when you go through that analysis of
Yeah.
prevailing wage, union or not union, um, is there any other incentive on from your standpoint, like a non-tax incentive to using the union?
There is. So if you want to use HUD financing at the construction stage requires prevailing wages. They call that the Bacon Davis rates.
Right.
There's fixed rates based on that market that you have to use, and union usually guarantees that you're there. Um, uh, and so that allows you to get cheaper financing, gentler financing. But from our perspective, it tends to be really hard to get there because it then also forces buckets of labor that you don't want to be in. So it really just depends on the project.
Yeah. Yeah. Appreciate that.
Yeah. Well, so I want to just go into the worst case scenario here. So I hired the wrong cost seg person. What could go wrong? What are the guys without your level of experience like? What should I watch for?
Look, the IRS can be a bully, right?
Yeah.
They can just be a bully if they want to be. We're dealing with a situation right now where somebody had a cost segregation study done by another provider. The IRS is frankly, saying things don't qualify, and the owner kind of realized that the provider that they hired is not able to deal with the IRS because it just wasn't going well. So they hired us. Now they're probably paying 3 or 4 times the amount that they would have had they just hired a reputable firm to begin with. And we're helping them navigate and shield them from the IRS, kind of overstepping the line. The
Yep.
IRS will do that, and if you don't have someone on your side that can stand up to them and tell them, nope, that's not going to fly. We don't agree. We're going to fight it. It can be a long, drawn out process in that case. So that's the kind of thing that can go wrong.
So what happens if I hire KBKG and the IRS still comes back at the end and is giving me a hard time? What happens? How do you deal with that?
Yeah, yeah. Look, audit support is included in all of our studies, right? And so we will defend it. We'll spend all the time that's needed to defend it, and we have a 99% success rate under
Oh,
IRS
wow.
audit over 27 years. Okay, so we we go through a number of audits because we're one of the bigger COSIG companies in the country, and it's funny. My partner that was dealing with an audit. Um, he got on the call with the IRS, with the client, and with the CPA firm. And the IRS agent said, his name is Malik. He said, Malik, normally I would push back on this in that issue, um, but because we just went through this on another audit and we resolved it, I'm not going to even go there, right? So like the audit ended quickly. He knew he was dealing with KBKG, that it wasn't going to be an easy fight, and we resolved it in days versus months or years.
Your reputation precedes you. They're scared of you now. That's good.
Well, I don't know about scared, but they just know they can't bully us.
That's fantastic. All right, so if somebody wants to get in touch with you, they need a cost seg study. How can they get a hold of you?
Yeah, look, kbkg.com is my email address. My contact information is on there. I was going to flip over to also I'm going to share my screen here for my contact information slides. So there it is on the screen. Here's my
Amazing.
LinkedIn, Facebook, Instagram. I'm very active. I'm always posting tax strategies and tips, especially for real estate investors. And yeah, would love it. Feel free to visit my website. Give me a call if you have any questions.
Awesome. And let me open it up to questions. I know we got a lot of people out in the audience. Does anybody have any questions? I'll give a moment for people to write it into the chat if you do. And actually, while you're collecting questions, you can unshare, and we're gonna send this around in our thank you emails. You can unshare that.
Yep.
But Uh, while people have the opportunity to write in some questions, I want to do a shameless plug for our latest opportunity. So we are acquiring about 1,200 beds of student housing in Gainesville, Florida. It's going to return a 25% IRR, about two and a half times your money in 5 years. It's a light value add, but this property is absolutely incredible. Walking distance to Santa Fe College, easily commutable for University of Florida. We service both campuses, which is great. We're going to do a light renovation, raise some rents. The expenses on the property are insanely high, and so we know we can get those down pretty dramatically. And so this is a kind of a light lift property for us, but a great way to get to a 25% annual return for our investors. So if you're interested, looking forward to talking to you about it. Please reach out to me, and I'd love to talk to you about it. But we will be using KBKG to do our cost seg study, and we're expecting 75 or an 80% depreciation or somewhere in that range, hopefully in year one. So with that, any questions out there? Let's see.
I'll just add to that, Jeff. I see a lot of deals come across my desk, and I looked at the deal you're talking about, and I'm obviously I'm like I'm investing in the deal. I think it's worth anybody taking a look if they're interested in something like that.
Thank you. And I will say, um, uh, I have a we have a lot of investors, but the ones that I'm most grateful for are the experienced real estate investors like you that take a look at our deals and trust us to come along. But that's real validation for us. So thank you. And oh, we do have a question. Wait, let's see. Since the GP does the cost seg, is this cost seg info just good for LPs to know so they can check the K1s for the correct info so we can maximize our tax savings? So I'll say, so basically you're saying, since you're just along for the ride as an LP, do you care? So short answer is yes, you do care. So number one is as you're looking at where to invest, you want to make sure that this is happening because it doesn't happen on all deals. However, if you are on a deal where this is happening, you have to understand what you're getting. You have to understand how to project that, all right, I'm getting a lot in year one, a lot less in future years, so that you can project your taxes, because it does affect what your return will look like in future years. But you also have to be aware about the recapture and know that at the end, it all comes back out in the wash. And so uh, the taxes take a big hit of all of our cash flow. And so your ability to project what's going to happen for the next 5 years in some way is really important. So great question. But Gian, how would you add to what I just said there?
Yeah, you answered it great. I would only add that you know some sponsors don't factor in cost segregation. Some of them don't do it for some reason. Some of them do it, and it's becoming more common now that they're showing and telling investors like what it might look like in year one. But if you're depreciation motivated, right, like I am, like it is something that impacts my decisions on the investments I make.
Yeah, we have several investors that, despite the fact that we deliver lots of cash flow, they're not with us for the cash flow. They're with us for the depreciation. That's really what they care about. And so we're excited to give them cash flow, and they're certainly not turning away our checks, but that's not why they're here. They're here for the depreciation. Um, All right, so I think that's all the questions we have. But feel free, email me. You have Gian's email as well. Email Gian with any questions. And thank you all for being here with us. And Gian, thank you so much for the learning. Even though I've been doing cost seg studies for many years with your team, I learned a lot. And so hopefully everyone else did as well. And hope everybody has a great day.
All right, thanks. Thanks, Jeff.
Thanks, everybody.